Lots of people think Medicare is free, but it really isn't. And here to talk with us about that is Dana Anspach from Sensible Money. Dana, welcome.
Thanks, Bob. Great to be here.
Great to have you here. And it'll be great to have you walk us through all things Medicare.
Not the most exciting topic, but very important as you're nearing retirement.
Well, and that's true. There's probably somewhere between 3 and 5 million people that will become Medicare eligible each and every year.
There are, and the majority of people are going to enroll in Medicare at about age 65. And I say the majority because if you're still working and your employer has over 20 employees, sometimes you will defer the enrollment of what's called Medicare Part B. Most of the time, you still enroll in Part A. And there is a misconception that Medicare is free. In reality, there are parts of Medicare. Part A is free for most people if they've worked long enough in the U.S. to qualify. Generally, if you're eligible for Social Security, you're eligible for Medicare Part A for free. But there is also Part B. And Part B, you pay a premium for this. And so it's a little different. Part B covers additional services and supplies, whereas Part A is referred to as hospital insurance. And there's also a Part D for prescriptions. And there is or can be a separate premium for some people for Part D. So it's more complicated than people think.
Right. And of course, there's Part C, Medicare Advantage, where there's also a premium in some cases for that as well.
There is. Yeah. It's not so simple as just, hey, I get free healthcare once I'm 65.
All right. So tell us a little bit more about how these parts work and the premiums and how they're calculated and what people need to know about them.
Yeah. So what they do is the Social Security office looks at your tax return 2 years prior. So let's say it's 2022, you are turning 65 this year and you are enrolling in Medicare. They're going to look at your tax return for 2020. And if your modified adjusted gross income is in 2020 was below 91,000 for single, below 182,000 for married, then your Medicare Part B premiums will be $170 per month, and your Part D prescriptions will actually be free. But here's the catch. If your modified adjusted gross income, what we refer to as MAGI, exceeds certain threshold amounts, you will pay more. This is referred to as means testing. Technically, it's called the income-related monthly adjustment amount. It's referred to as IRMAA, IRMAA. And you are notified of this with a letter that comes from Social Security. It's called your initial determination letter. So let's look at an example. Let's say your modified adjusted gross income was greater than 142,000 for single or 284 for marrieds. Well, then your Part B premium would be $442 a month, not $170. And now you would pay a $52 per month premium for Part D. When your income continues to tier up, when you look at the highest tier, you would pay $578 a month for Part B and $78 a month for Part D. And that applies to singles who have modified adjusted gross incomes greater than 500,000, married greater than 750. It's a lot.
It's quite a bit when people think about how much healthcare will cost in retirement. So Dana, before I ask my next question, what is MAGI?
Well, that's a great question. There are many different versions of MAGI. So there's different calculations depending on whether you're qualifying for the healthcare tax credit or doing a Roth conversion, or, for example, determining your Part B premiums. So for Part B premiums, you take your AGI, adjusted gross income, which is on line 11 on a 1040 for the 2021 returns. And then you have to add back any tax exempt interest. So if you own municipal bonds, tax-free interest from those, that would be an add back item to come up with your MAGI. And that's the number that they will use in determining your Medicare Part B and D premium amounts.
Dana, what happens if you're retired and your income is lower now?
That's a great question. So let's say, they're looking back at your tax return in 2020 and now it's 2022 and you're retired. Well, there are reasons that you can request a new initial determination letter, and stopping work or having reduced work hours is one of those reasons. There are other reasons, such as you got married or you got divorced. There's some reasons that, are unfortunate, such as if you had a pension that suddenly stopped and didn't pay out anymore, or if you lost an income producing property due to a disaster primarily. So if you just sold an income producing property, that wouldn't count. But let's say a hurricane came along and wiped it out. That may be an event that would allow you to ask for a new determination letter. So there are some reasons. Another reason would be if you had filed an amended return for 2020 and that amended return had income that was below the threshold amount. You want to request a new determination letter very quickly. So when you get that letter from Social Security and it tells you you're subject to this, if you think you qualify for a lower amount, you're going to want to reply. And there's a form that you will need to fill out. And that form is accessible online. And you can also call the Social Security office and get that.
So what about some other examples? Let's say someone did a Roth conversion or sold some property.
Yeah, so those are definitely examples that can cause you to move up into a higher income threshold. So let's say you had done a Roth conversion in 2020, and that income will push you into a higher threshold amount, and you cannot request an exception to lower it for that. Now, I have seen people forego Roth conversions because they don't want to pay the higher Medicare Part B premiums. And when we run the analysis, usually it still works to your benefit. So even when you factor in that for a year you would pay those higher Part B thresholds, it often works to your advantage to do the Roth conversion anyway. I think the other you asked about was selling a property. And so, if you sold a property and you have a lot of extra capital gains and that pushes your income over the threshold, that is not going to be an event that you can get an exception for. That event, it might be from selling a business, is going to make you pay the higher Part B premiums. The good news is, let's say that happened in 2020 and in 2021, your income was back under a threshold. Now your premiums in 2023 will go back down. So once they move to a higher threshold, it's not permanent.
So you talked about filing an appeal. Talk more about that.
Yeah, so the technical language is when you initially get your determination letter, you can request a new determination letter. And if that is rejected, then you can file an appeal. And so I think you have 60 days to do that, and that could be rejected too. So sometimes it's called an appeal. It might be called a recalculation. And so the Social Security language is a little strange around those things. But what happens with most people is the first step is you are requesting a new initial determination saying, hey, I shouldn't pay this much. And then if that gets rejected, you would move on to the appeal process. The letter you get from Social Security will spell out the steps when you need to do it and how you do it. Most of the time it's you're going online or you're calling the Social Security office or you're making a visit to them. Not the most pleasant thing, but it may save you a lot of money.
Yeah. And in terms, if you were a betting person, what kind of odds do you give folks in terms of getting their appeal done to their satisfaction?
I'm not sure about appeal, but in terms of the initial new determination, if you qualify for one of the reasons, and when you fill out the form, it spells out very clearly, like here are the reasons. So let's say you're retired. That's a very valid reason. Your income's lower now, then your chances are virtually 100%. They will reconsider and say, oh, that's right. Your income was higher in 2020. You're not working anymore. And so, yes, absolutely, you qualify for the lower amount. So if it's black and white, you're going to get the lower amount.
Anything that we haven't touched upon?
Oh, probably a couple of things. When we think of Medicare Part B and D premiums, it's not technically a tax, yet I think of it as a tax. So when you think of these types of premiums, they are going to impact anywhere between about 5 and 10% of taxpayers. And it's something you can plan ahead for. So if you were to look at, for example, someone who has a large amount of money in an IRA or a 401k plan, and their required minimum distributions are starting at 72, and they're not drawing anything out until then, suddenly they could have an extra 6-figure distribution coming out of these plans that pushes them into one of those higher Medicare Part B and D threshold amounts. And it catches a lot of people off guard. So if you plan ahead, often in those years between, I call them the opportunity zone years, between age 60 and 72, and intentionally draw money out of the IRA and 401k or intentionally convert to a Roth, that type of planning may keep your income low enough later that you don't cross into a threshold that's as high. And when it's done right, it can save you money. So I encourage people to look at that kind of planning. The other thing I always like people to know is if you're doing your planning, you're often delaying Social Security, or at least one spouse is. And so when you start with Medicare, particularly Part B, if you're not collecting Social Security yet, you will get a quarterly invoice. So it's something you would need to budget for and pay for. Once you're collecting Social Security, they just debit those premiums right from your Social Security check.
So a couple of things come to mind for, as you mentioned, planning for folks who are thinking about what their Medicare Part B and Part D premiums might be in the future and what the thresholds might be. Any words of wisdom there?
Well, they are indexed to inflation. And so here in 2022, we saw a pretty big increase from what it would have been if you were first enrolled in 2021. However, there is can't remember the technical term for it. You might know, but once you're on Social Security, there's a certain kind of cap. So it can't increase beyond the increase in your Social Security benefit.
Right.
And so there is some, hold harmless provision. Thank you. So there is a provision once you are once you're already enrolled that will help protect you from inflation increases that are too large. But right now, what we do is in our planning, we project all healthcare premiums, including Part B and D, as if they're growing at 5% a year. And we're just building that into the potential expenses for someone that may be retiring 5-10 years from now.